Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the April investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weiss, about what's going on in the markets and investment universe that you need to know right now. Bob, a little bit of a good start to the year. Market volatility seems to be subdued, but that doesn't mean there's not stuff to talk about and educate our listeners on. What's on your mind lately?
Yeah, well, first, Q1 was a great quarter. Stocks performed quite well. I can run through the numbers. Bonds were about flat or a little down as interest rates rose, but most investors have, even if it's not the majority of their assets, the majority of their investment risk is in the stock market. And Q1 was strong in 2024, and that was on the heels of a strong Q4 2023. So we're looking at really 6 good months of really strong investment returns, coming off the heels of a lot of concerns about a recession. So it's been a good period to be invested.
So touching on that, because I shared a couple of articles related to this recession that didn't happen and two really telltale signals that people follow related to recessions, which is A, the inverted yield curve, and B, the Conference Board's leading economic indicators, which I know you've touched on in the podcast. Both were signaling we were going to have a recession, or maybe we are. Well, we know we are at some point, but I would imagine the indicators were pointing to, or they're useful only if the recession is coming within a reasonable time frame from when they first turn on. And we didn't have that recession. So as an investor who watches these things, and you don't necessarily always react to them because you can't and shouldn't, but as an investor who watches these things, the inverted yield curve and the leading economic indicators, how do you feel about those two predictors of recessions, given the recession that we didn't happen?
Yeah, the inverted yield curve by itself is a tricky one because the yield curve can stay inverted for a long time before the recession comes. Like even back in the financial crisis that was in 2008, I think the yield curve started inverted in around 2005. So it took a while, and most people don't have that kind of patience. The leading economic indicator composite, of which one of the components is the yield curve, has a really strong track record. But the sample size is still pretty small. As far as the number of recessions that we've had when you're looking at the data. It's not like it's called 30 out of 30 recessions and it's statistically significant. But to your point, like the LEI came out for February, I think last week, and it was positive for the first time since February 2022. So this is a data point that's released monthly, looking at a bunch of different economic data points, and it had been negative and declining for 24 straight prints, and now it was positive 0.1%. So not hugely positive, but at least directionally, it's kind of changed. So what does it mean? I think I've mentioned this before, but well, one, you can't bank on anything to be 100% accurate about predicting the future. But two, I think there is something too that the last couple of years have been unusual from the pandemic, and the way the economy shut down and then started up, and consumer spending was shifting around from buying durable goods at first to then services. As early on people are buying bikes, then later on people are going on vacations, things like that. It just led to a really unusual period in the last few years.
And I keep saying it, and I have to add the caveat in that I know it's not the technical definition of a recession, but we did have 2 negative quarters, GDP quarters, early on in this recession watch. So the inverted yield curve can be early, I guess is what you're saying, which I believe I saw something where the median time after the yield curve inverts is up close to 2 years to the recession. So it can be early. And if it's early, and that's the median, so there are time periods where it's even longer than that that you have to wait. Not necessarily useful as a timing tool, kind of similar to CAPE ratios with valuations. They can tell you something, but they're not telling you that there's a market correction coming around the corner. With the leading economic indicators now turning positive, I've seen some thoughts that there's just issues with those indicators and they need to be revisited a little bit. Have you seen that, or do you feel like that's just maybe Monday morning quarterbacking for the one time that they didn't work recently?
Yeah, I'd say more the latter there.
Okay.
Yeah, as opposed to real concerns. And with the inverted yield curve, maybe to step back and for our listeners, what it is, it's when short rates are higher than long rates, like looking at government bonds. So when, like a 90-day T-bill or a 2-year treasury has a higher yield than, say, a 10-year treasury. And normally it's the opposite. As you go out longer in the yield curve, you get a higher yield, a normalized upward slope in yield curve. So if you think about an inverted yield curve, why would it be inverted? And it's typically inverted because you're in a Fed rate hiking cycle. The Fed has increased short rates, which they control above the average long-term rate. And why would that lead to a recession? Well, the Fed's trying to slow down economic activity because they're in inflation fighting mode. So that's why the inverted yield curve isn't just some random data point that coincidentally leads to recessions in the future. It's real because it's indicative of restrictive Fed policy. So this time around, we're still in an inverted yield curve, and we have what looks to be cycle peak rates. So we're not out of the woods yet, but it's that soft landing that people talk about, where the Fed then maybe takes a stair step back down, the yield curve normalizes, and we do it all without a recession. So yet to be seen, but that is now turning into consensus.
So we're in a good market environment, as you mentioned. We're about 18 months really off the market bottom in October 2022. Last year, we did see some volatility. We saw a bunch of 5% moves, and then we saw a really strong rally in the fourth quarter. This year, it's been very subdued, as I think you said at the outset, low volatility.
Yeah.
Does that matter?
It it doesn't really matter other than maybe a reminder for our listeners that there's volatility in the stock market. So it's
Right.
not like, yeah, I have tomorrow's newspaper here and it's going to get rocky. It's just don't get complacent. Don't get your stocks confused with your bonds as far as like risk profile setting. That the 10% decline that you do see on average, I think it's even what 14% in the average
14. Yeah.
that very well could be coming, and just don't get used to, lull it into a sense of low stock market volatility or increased risk beyond where you should be.
Yeah, that's a slide that we love. We get it from the JP Morgan Guide to Markets, where they show, I think since 1980, the average intra-year stock market decline in the US is about 14%. And you raise a good point in terms of not being complacent, because I've had an uptick of questions recently from people about the questions, fall in many different flavors, but it's basically, should I take on more risk? The market seems to be doing pretty well. And you tend to get those at the wrong time. And we have not had a measurable decline for a while. And you have to understand that we are due for a double-digit decline in the normal course of business at any point during the calendar year. And so the longer we go without one, sometimes you can be lulled into taking too much risk and deviating from your long-term plan.
Exactly.
Thanks. All right. So you also have seen some maybe evolving leadership in the market, or more maybe a better way to put it is participation is broadening beyond this quote unquote Magnificent Seven.
Yeah, the story of 2023 was the Magnificent Seven, seven tech stocks that led and delivered a bulk of the total market return. And then as we look this year, that group of seven has diverged, with Apple, Tesla, and Alphabet have underperformed. Nvidia, Meta, Microsoft, and Amazon are performing well. Nvidia's done really well. It's up over 80% year to date. But Tesla, on the other hand, which had been one of the top favorite stocks for a while, has really struggled over really the last couple of years. So I think there's a little bit of a takeaway just from this that, people on TV trying to come up with, cute acronyms and taglines for a group of magical stocks that are, going to be the winners. But I think our very first podcast 2.25 years ago was on the FANG stocks. And, it's just interesting as we keep doing this, the acronyms keep changing, the groups of leaderships, it changes. NVIDIA wasn't in the FANG stocks. It was Netflix at the time, and
Right.
no one's talking about Netflix anymore. So just interesting to observe that leadership changes, winners come and go, and there's no just like magical group of stocks that'll carry you through a financial plan.
I had Jeff Kleintop from Charles Schwab, their chief global strategist, on the podcast recently, and he shared that the average international stock is outperforming the average US stock by 10 percentage points. But if you're looking at market weighted indices, you don't see that. So is that another indication of what you're talking about? The winners are broadening out and it's not just a handful of AI related tech names?
It is, yeah, that speaks to the strong performance of international markets that we've seen. And in the US, it still has been led by the larger companies, but that was, definitely a 2023 story. And it's still there this year a little bit, but we are seeing it broaden, especially more recently, like in March, for example. Small caps did well, value did well. So there's some catching up to do with call it more winners in the market, rather than just a handful of the big companies doing well.
Any concerns, Bob, with fixed income being flat for the quarter? I know you explained why, but I would imagine investors are looking for some positive returns from bonds in a quarter where yields are attractive.
No, no real concerns. It basically comes down to rates went up about 20 basis points on intermediate to long-term bonds. And when you have a duration of, call it 6 on average, 6 times 0.2 is 1.2. And that's, kind of the rough back of the napkin price decline, which offsets the yield. So rates went up a little bit. And I think it was in Q4 2023, markets got a little ahead of themselves. They were pricing in 6 rate cuts this year, and bonds did great. They were up, north of 6% just in Q4 last year, and they gave back a little bit of that. I think that kind of the bigger concern is inflation, and this is what bonds are reacting to, and it's will we see 2% inflation from the Fed? That's what they want, and it is not proven to be easy to get there. I guess no one said it would be. But one thing that I've noticed is if you look at CPI, there's a lot of ways to measure inflation. There's CPI, PCE, there's core, super core. Well, you can measure it over different time periods. But if you just look at CPI and exclude housing, it's 1.8% over the last year. So you just take out housing, and CPI is where the Fed wants it to be, even a hair lower. And housing has just been very stubborn, just showing strong increases, and we're entering the spring housing market here. And from everything I'm seeing and hearing, it seems like it's strong. So that's just something to keep an eye on, because I know some people in real estate say housing's not going to break until they cut rates. So you have a bit of a I don't know, chicken and the egg here, where if the Fed's not going to cut rates until inflation slows, and housing's what's keeping it up, and housing's not going to slow down until they cut rates, you're stuck. So I feel like that's one risk to just be aware of.
A risk how, Bob? That just we don't cut rates, but even maybe increase them?
Correct. It's a long answer to the bond question,
Okay.
about, am I concerned about the performance in Q1? And it's the performance in Q1 is a reaction to inflationary pressures not going away. And that is how that could continue to persist. If we have, say, a strong spring housing market and the Fed doesn't cut rates, then that's not good for bonds.
Yeah, no one said the inflation fight would be easy. You said that, especially you. You said inflation is sticky and there will be fits and starts. So is that what we're seeing right now?
Yes.
Nice. Okay. What else is on your mind, Bob, in terms of the investment universe right now?
Yes, we talked about LEI, inflation, yeah, brought it into the rally. I mean, just to read off some numbers, for Q1, the Russell 3000 total market in the US returned 10%, for first quarter. Looking overseas, world ex-US was up about 5.5%. Emerging markets were up about 2%, 2.4. So we still saw US leadership, which has persisted. I know Jeff Klantop talked about that changing if you look at the average company. So how much the you know capitalization weighting methodology plays into that, we'll see. Bonds were down about 78 basis points if you look at the BarCap Ag Index. So just quick run through of
What
Q1.
about developed international, Bob?
Yeah, developed international measured by the MSCI World ex USA was up 5.59%.
5 point. All right. So that includes Japan, which is doing really well, and developed international also includes Europe.
Yes.
Okay.
So
And
overall,
so,
quarter healthy returns.
yeah, good returns in the quarter for sure. When you look at an environment like this, what is your team focused on kind of day in and day out from an investment standpoint? Like what's on your minds?
The way we invested is more long-term in nature, so we are more operating on like annual projects and goals and looking into managers. Recently, we've been working on private equity quite a bit, looking for a 2024 fund to make a commitment to. So nothing too like in the weeds in the news, say that we're working on. Just kind of taking deep dives into the products that we're working with and covering new products as well.
So, Bob, I recently shared at a seminar I put together for people who are planning on retirement some statistics about being patient with your investments. And basically, these are numbers that you've seen before. I think you were the first person to bring them to my attention. But if you look at top quartile investment managers, so managers in the top 25% of their category for an entire decade, so these are the managers you are looking to invest with. There are extensive periods of time when they do not perform well at all. And, the point of that in terms of bringing it up in the presentation was an impatience jumping from strategy to strategy can be an investment mistake. And just to kind of put some, meat to these numbers, 89% of the time, these top quartile managers can be below median for a 3-year period. 62% of the time they can be below median for a 5-year period in the 10-year period where they're top quartile managers. It's a great point related to impatience, but it does leave individual investors maybe wanting in terms of, well, how do I know when I'm ever supposed to sell something, right? So you're a patient chief investment officer, you're aware of these statistics, but you make changes to the portfolio, you make changes to managers. So how would you counsel investors to be patient without being blindly patient? What would they need to see in a strategy, in a fund, with a manager, with a management team to signal that this isn't just, great funds go through bad stretches, but here are some things I'd be on the lookout for, some red flags that would make me want to dig deeper.
Yeah, that research is fascinating. I love it, and it humbles you, and it makes you realize how difficult it is to analyze and maintain active managers. Because really, the takeaway is, okay, here's the managers that won. These are the best ones to have been in over the last 10 years. If you bought them day one, right before their great run, would you have actually held them and realized that? And most people don't. The manager hits that bad 3-year number, and maybe that turns into a bad 4 or 5-year number, and they sell, and then they go on a good 5-year run, and they sold at the absolute worst time. So it gets down to process, people process, and internally having a process where you're checking the same things and not looking at performance in, I'd say, in isolation, like we do. What we do, it's performance attribution. So it's not just how do you look compared to the benchmark, but it's how do you look compared to the benchmark and why, and digging into that. But it's more things that would lead to a sale. First of all, ideally, you're selling your winners, not your losers. So if you have a portfolio of, say, 15 funds and you have 5 outperforming, 5 around the benchmark, and 5 below the benchmark, which I guess that equal distribution is not ideal, but still, you actually, hopefully, you're looking to sell the ones that are outperforming. At least take profits there and maybe rotate money into the ones that are losing. So don't in isolation. If I just laid it out like that, you have winners, alt flat, and losers. Where should you put your attention? Don't disproportionately put your attention on the losers, because right away you're kind of setting yourself up to sell low. Now, if you have a loser and there's things going on, like key people are leaving the firm, they're changing their approach, there's asset bloat. Like if it's a small cap strategy that did exceptionally well with a couple 100 million and now it's at 10 billion and they can't buy small companies anymore, things like that. But it's really just digging deep and understanding what's driving the returns, and is it more environmental, because not like the environment, but like the market environment, because managers have a style and approach. And the reason why the data exists the way it is investment styles come in and out of favor. And what you're really trying to tell is, are they sticking to their knitting and it's just not a good time for their style that's out of favor? In which case you have to give them a pass during a period of poor performance. Or is it more than that? Is it they've changed their style? The people have changed, the process has changed, things like that.
So we manage money. Well, we've talked about it before, but we start with a client's financial plan because you need to understand the amount of risk that they can take, the willingness to take risk, the capacity to take risk based on when they're going to need their assets. And then we build an asset allocation. Your team builds an asset allocation using long-term capital market assumptions. And then you have to implement that allocation with strategies in each category. Putting you on the spot here a little bit, but what's harder, to build the right long-term asset allocation or to choose the managers and strategies to implement that allocation?
Well, that's a good question. Yeah, I mean, I'd say both are challenging. What's tricky with the capital market assumptions is they are 10 years in nature. And for that reason, it takes a while before you really know how you're doing. So you don't really get an immediate report card, so to speak, on that. Um, I would say that that process, I mean, we've talked about it internally here, looking at capital market assumptions, even third-party provided ones, even if you look at, big Wall Street banks, they've loved emerging markets for the last 10 years
Mm-hmm.
and have not been fond of US equities. Really, it has been the capital market consensus, and that's been dead wrong. It's really been the opposite. That US has been the place to be, and emerging markets have lagged. And basically, just about anyone I know who's put out CMAs has had that wrong. So that has been challenging, and we've looked into it on the manager selection side. So I guess maybe I am talking myself into the manager selection side is a little easier. That's where if you talk to enough managers, I do think you can get a feel for who has a good process, who has a good team, who has good experience and really knows what they're doing and is a true expert in their space, and who is behind a bunch of pretty marketing material and there's not as much substance there. So we see a lot of bad products and we can sniff them out pretty quickly. So being able to identify strong, unique providers, probably say that might be a little easier than picking asset classes even over a 10-year span.
Got it. All right. And anything else, Bob, that you wanted to touch on as it relates to investments, inflation, the Fed watch, things that we've talked on and on about
Oh, I think
through
enough.
multiple episodes?
Yeah. No, nothing else there.
All right. Reading anything good lately?
Did read a book recently. I'll share the background a little bit. I was out with some friends, and one guy is a lawyer, and the other one's a software engineer. And they said to me, "Bob, have you heard the like rule of three generations, where one generation earns the money, the second like preserves it, and the third squanders it?" And I smile and nod, yes. And they said, "Well, how do you stop it? How do you prevent that from that happening in your family?" And I said, normally pretty good when my non-finance friends ask me questions on the spot, but they kind of stumped me with that one. So my initial response is, well, first I've seen first generations who earn a ton of wealth and spend it all themselves, don't even make it to the second. But then, I have seen three generations of wealth where you have three generations of successful doctors, corporate executives, lawyers, etc. And so it's not a hard and fast rule that's destined. But the question of what do the families do who have call it the successful three generations differently from those who maybe follow that rule of thumb where it doesn't last, I don't know. So I got back to the office and I talked to Ed Jastrom, our chief planning officer, and said, Ed, who has like a dozen designations and has read all kinds of like personal finance books, I asked Ed for a book recommendation or if he's come across anything. And he thought about it and he said, oh, there's a book out there. And he was poking around on Amazon for a little while. And he knew there was one perfect for this. And it's called The Opposite of Spoiled. It's by Ron Lieber. Ron used to work for the Wall Street Journal and more recently the New York Times. He's the Your Money columnist. So I read it, and it's a great book. I think Ron, if we can get him, would be a good guest on this podcast.
Interesting.
But he had, a lot of points in there that get into the weeds of tactics and parenting. Maybe individually doesn't kind of hit the question squarely, but something like, something I can relate to. He said, you want to find someone with a good work ethic, find someone who grew up on a farm. And his point with that was the importance of working for kids. Don't just have your kid like be a kid and take SAT prep classes. Like have them get a real job. That'll teach them things in life. That was something that was interesting. And then like a one in, one out rule with toys. Like I take my kids to the bookstore and they always want to buy a toy. And I actually shared this with them and it got their attention. If you want to get a toy, then you have to give a toy away. And that does a couple of things. It teaches giving. In the book, someone's given it to like a children's hospital. And it also kind of puts a little bit of a headwind on the consumerism, materialism mindset. So, you don't buy so much and instead save. Gives them an incentive to save. And then maybe a little deeper in on the finance side, how to answer questions about money. If kids ask you like, oh, mom, dad, how much money do you make? Or how much money do you have? That can be a little tricky one sometimes. So his tactic, which I know you typically don't like, Sammy, answering a question with a question, but you put it back to him in a very like kind, soft way. Oh, why are you asking? Just to hear like why are they curious about that, and then don't have it be a wasted opportunity. Oh well, let me first teach you about how we spend money in this household and review a family budget with them, review a credit card bill with them. And there you're teaching financial literacy. You teach them about expenses. You teach them kind of a philosophy on how we choose to spend our money. And they learn something about it. And eventually they'll probably get bored and be like, all right, dad, enough, and they'll leave. So you didn't, stiff arm the question or dodge it, but you taught them something and hopefully appeased, their interest for a little while on that topic.
You're better than that at me. Typically, the question in my household is framed, how much money do we have? And I said, well, your mom and I have enough for this conversation. You don't have any. And so that gets them to leave the room maybe quicker than you. So you would recommend this book?
Yes.
Yeah. And what age parent or what kind of life stage would you think it would be most useful for?
It ranges from things like allowances, so I think it's great for people with kids who are, whatever, 5, 10, 12, 14, like in that range, I think is square in the bullseye. But some of those topics, do get more serious and for older kids. And Ron also has a book on college, which I haven't read yet, but like choosing colleges. So he's involved in that too. So even if your kids are more in the high school, college age, might be a good resource.
Great. I was just a kind of a question in passing, but it turns out you read something really interesting and to be useful for our listeners. And I'll grab it and we will try to get him on the podcast. Bob, everybody's filing taxes now, or they should be in the next week or two, or at least going on extension. We've talked about, tax loss selling before, asset location, different things to do in your portfolio to minimize the tax bite. Are you seeing anything in particular, this year, or hearing anything from clients that make you want to reemphasize any of those points?
No, maybe one thing to add that's a little newer is we've been doing more and more with ETFs instead of mutual funds.
Mm-hmm.
And ETFs are a more tax efficient vehicle. And one of even the mutual fund managers or managers that we work with that has both ETFs and mutual funds, they've made their mutual funds more tax efficient. So overall, there's kind of an underlying theme of reducing capital gain distributions, whether it's through the use of ETFs or through the use of more tax managed mutual funds. So when we were looking back in hindsight, 2023, from a distribution standpoint, was a fairly tax efficient year, especially in light of how strong stock returns were. And want to be careful about not over promising here. It's not like there will never be capital gains again, but that is an emphasis of ours that we're working on as part of product selection is seeing that we're being tax efficient in the investment management here at Heritage.
Great. Thanks for the update, Bob, and thanks for sharing your time as always. It's a treat, I feel, to be able to pick your brain, and I'm sure our listeners would agree.
All right, thanks, Sammy.
Thanks, Bob. Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.